So you want to own a mining business? One number can wipe out $430 million. You just bought a copper mine. On paper, it makes you $430 million a year. Then copper falls by $1. Your $430 million almost disappears. Nothing broke. The same mountain is there. The same trucks are moving. The same workers are showing up. You changed one number. And price is not even the most dangerous number in this business. One tiny change in the rock can erase another $280 million. One wrong estimate can add $55 million to your annual costs. And after the mine stops producing, you can still receive a bill measured in billions. So, do you still want to own a mining business? Good. Here's exactly what you are buying. Imagine your mine processes 100,000 metric tons of ore every day. That is 36.5 million tons a year. The average copper grade is 0.6%. In other words, every metric ton of ore contains only 6 kilograms of copper. You must drill, blast, load, haul, crush, and process the entire ton to reach those 6 kilograms. And you still do not recover all of it. At 88% recovery, your mine produces about 193,000 metric tons of saleable copper per year. That is roughly 425 million pounds. At $4 per pound, the headline number looks incredible. About $1.7 billion in annual revenue. That is the number people see. Now let us look at the number you keep. Your cash operating cost is $2.20 per pound. Across the year, that is about $935 million. So your mine-level cash margin is roughly $765 million. Still sounds fantastic, but the mine needs new equipment, new tailings capacity, new mining areas, and constant infrastructure work. Set aside $250 million for sustaining capital, then assume a 5% royalty on gross revenue. That removes another $85 million. Now you are down to roughly $430 million, and that is before corporate overhead, interest, taxes, working capital, and reclamation funding. Your $1.7 billion mine is not a $1.7 billion profit machine. It is a $430 million margin surrounded by moving parts. Now copper falls from $4 to $3 per pound. Your revenue drops by about $425 million. After operating costs, sustaining capital, and the royalty, only about $25 million remains. $1 vanished from the copper price. More than $400 million vanished from your cash flow. At $2.80 per pound, the mine is already negative after those items, before interest and taxes. Same mine, same people, same equipment, different owner outcome. That is the first trap. You control the operation, but you do not control the price. When copper rises, every extra cent looks like genius. When copper falls, the mountain does not care how good your spreadsheet looked. But suppose the copper price stays at $4. You should be safe, right? Not yet. Because your next threat is inside the rock. Your model assumes an average grade of 0.6%. Now the mine delivers 0.5% instead. That sounds almost identical. It is not. At the same throughput and recovery, that tiny decimal removes roughly 70 million pounds of saleable copper per year. At $4 per pound, you lose about $280 million in annual revenue. The trucks do not become 20% cheaper. The mill does not need 20% fewer workers. The power bill does not politely fall with the grade. Most of your cost stays. Only the valuable part of every ton gets smaller. Now, recovery slips from 88% to 84%. You mine the same ore. You crush the same rock. But less copper makes it through the plant. That 4-point miss removes roughly 19 million pounds of annual production, worth more than $75 million at a $4 copper price. The copper was in the rock. You simply failed to sell it. And the plant can miss for reasons a cold spreadsheet hides. Harder ore slows the mill. Clay reduces throughput. Some minerals need finer grinding, more energy, or more chemicals. Other minerals create penalties when you sell the concentrate. You did not buy one uniform mountain. You bought millions of tons of rock that behave differently every day. Then comes the rock with no copper in it at all. In an open pit, ore is usually trapped behind waste. At a strip ratio of 2:1, you move 2 tons of waste for every ton of ore. Your mine plan assumes that ratio. But the real pit delivers 2.5:1. For a mine processing 36.5 million tons of ore per year, that extra half point means moving about 18 million additional tons of waste. At $3 per ton for drilling, blasting, loading, and hauling, your annual cost rises by roughly $55 million. You spend $55 million. You produce no extra copper. You only reach the copper you already thought you owned. Price, grade, recovery, and strip ratio. 4 ordinary numbers. Any one of them can destroy the margin, and they rarely wait for their turn. A weaker price can arrive during a lower grade phase while the pit is moving more waste and the plant is recovering less metal. That is how a mine that looks profitable in an average year runs out of cash in a bad one. And we have not paid to build it yet. Before your first pound of copper is sold, you need drilling, engineering, permits, roads, power, water, workshops, fuel storage, worker housing, a processing plant, and a way to move the product to customers. If the mine is underground, add shafts, ventilation, pumps, refuge chambers, crushers, and kilometers of tunnels. For major mines that entered production between 2010 and 2019, the International Energy Agency found that the average journey from discovery to production took more than 16 years. More than 16 years before the mine earns its first sales dollar. During those years, you are still paying. Teams get paid. Studies get revised. Steel, concrete, labor, and equipment get more expensive. Interest accumulates. Governments change. Commodity prices can complete an entire boom and bust cycle before your first shipment leaves the site. You are spending today's money on a market that may exist 15 years from now. And the budget you approve is not always the budget you finish with. Look at BHP's Jansen project in Canada. It produces potash, not copper. Different mineral. Same owner trap. Stage 1 was approved at $5.7 billion. In January 2026, BHP raised the estimate to $8.4 billion. That is $2.7 billion added before the project sold a single ton. Then Stage 2 moved from $4.9 billion to $6.9 billion. BHP said it expected an impairment of about $2.3 billion tied to the broader project. The deposit did not disappear. The project can still become a major operation, but the owner now has more money, trapped up front and a longer road to earning it back. For Stage 1, BHP has guided to first production in mid-2027, followed by an estimated payback period of 11 to 15 years. That means the owner can spend billions, wait years for first production, and then wait another decade or more to recover the investment. This is why a mine can operate well and still be a poor investment. The operation answers one question. Can it produce? The owner asks a harder one. Was it worth everything we paid and waited? Time punishes you twice. A delay means another year of contractors, overhead, inflation, and interest with no operating cash coming in. At the same time, the future cash arrives later, so it is worth less today. At an 8% the annual discount rate, $1 received 15 years from now is worth about 32 cents today. $1 billion in year 15 sounds enormous. In today's model, it is worth about $320 million. Delay it again, and it shrinks again. So when construction costs rise and production slips, you do not suffer one problem. You pay more now for money worth less later. Then financing decides whether you survive the wait. Use equity, and you give away more of the company. Use debt, and the payments arrive whether copper is $4 or $2.80. Sell a royalty or a stream, and you solve today's cash problem by giving away part of tomorrow's production. There is no free money in mining. Every financing choice sells some combination of ownership, control, future cash flow, or safety. Now your mine is built. Production has started. The price is holding. You finally know your cost per pound. Or do you? Many copper mines also produce gold, silver, or molybdenum. Revenue from those metals can be credited against the cost of copper. That makes your copper cost look lower. But if the byproduct grade falls, shipments decline, or the byproduct price weakens, the credit disappears. The copper mine did not change. The reported copper cost did. Freeport-McMoran's financial disclosures show this effect directly. Lower gold shipments reduced byproduct credits and pushed expected copper unit costs above earlier guidance. The copper price did not need to move. A second metal changed the apparent cost of the first. That is why the most comforting number in a mining presentation is often the one you should challenge first. What is included in the cost? What is credited against it? What happens when the credit disappears? Then government takes its share. Corporate tax usually responds to profit. A royalty can be charged on revenue or production, even when little profit survives for you. Western Australia's standard ad valorem system shows the difference. Crushed or screen material can face a royalty of 7.5% of royalty value. Concentrates can face 5%. Metal can face 2.5%. In our mine, a 5% royalty removes about $85 million when copper sells for $4 per pound. At $3 per pound, the royalty falls, but it does not vanish. It still takes more than $60 million after most of your margin has already disappeared. And a permit can be more important than the tax rate. You need stable access to land, water, power, roads, exports, and labor. A blocked road can stop shipments. A disputed water permit can freeze an expansion. A rule change can trap product you already paid to produce. A mine is not just a hole, a plant, and a fleet of trucks. It is a chain. Break one link, and every asset behind it stops earning. Now for the bill most owners prefer to place at the bottom of the spreadsheet. Closure. Long before production begins, you need a plan to manage tailings, treat water, stabilize waste, dismantle facilities, reshape land, and monitor the site after the final sale. If the owner fails, the obligation does not disappear. It moves to creditors, communities, or taxpayers. Canada's giant mine near Yellowknife shows how large the final bill can become. The former gold mine left about 237,000 metric tons of arsenic trioxide, dust stored underground. After the former owner entered receivership, the federal government took over. The expected remediation cost is about $4.38 billion, with work extending into the late 2030s and monitoring after that. The gold was sold years ago. The bill survived the business. So what do you really own when you buy a mine? You own the price you cannot set. You own the grade you cannot see perfectly. You own the recovery the plant may miss. You own the waste sitting in front of the ore. You own the construction budget, the debt, the royalty, the permits, and the closure plan. The metal underground is only the beginning. Everything between the rock and the customer's payment belongs to you. That sounds brutal. But this is also why a genuinely strong mine can be so valuable. At $4 per pound, our hypothetical operation leaves roughly $430 million after operating costs, sustaining capital, and the royalty, before the remaining company-level costs. That cash can repay debt, fund expansion, strengthen the balance sheet, or return capital to owners. And when the copper price rises, much of the extra revenue can flow quickly into cash because the mine already paid for the people, plant, and infrastructure. The upside is real, but it belongs to the mine that can survive long enough to collect it. The best mine is not the one with the most impressive mountain. It is the one with enough margin to be wrong. High grade can absorb lower recovery. A low strip ratio can absorb higher fuel costs. Existing infrastructure can absorb a weaker price. A conservative balance sheet can absorb a delay. A funded closure plan keeps today's profit from becoming tomorrow's disaster. So before you buy a mining business, ask one question. Not, how much metal is underground? Ask, how many things can go wrong before my cash flow disappears? In our model, a $1 fall in copper took roughly $430 million down to about $25 million. A grade change of 0.1%. Point erased about $280 million of revenue. A half-point increase in the strip ratio added roughly $55 million of annual cost, and the final liability can outlive the company by decades. That is the economics of owning a mine. You do not get paid for the metal in the mountain. You get paid for the cash that survives the trip out. If you want more stories about what businesses really cost to build, cost to run, and can actually earn, subscribe to MR Capital for the next episode of So You Want to Own.